If your business relies on expensive tools or equipment, standard property insurance may not protect you the way you think, especially when that equipment moves, travels, or gets used off-site. Today I'll show you when standard property falls short and what to do about it. Hi, I'm Marty with JMW Insurance Solutions. We help business owners protect what they've built, including the high-value equipment that keeps revenue moving. For a lot of businesses, the most valuable assets aren't the furniture or the office supplies. The most valuable assets are specialized tools, mobile equipment, machines that are expensive to replace, technology systems, and equipment that directly produces revenue. When those assets are lost, damaged, or stolen, the business doesn't just lose property, it loses time, contracts, and cash flow. Here's where business owners get surprised. Many assume their standard commercial property policy covers high-value equipment no matter what. Sometimes it does, but often there are limitations that only show up when you actually file a claim. Today I want to explain what standard property is designed to cover, why it falls short for certain equipment, the common situations where it creates problems, and how to protect high-value equipment cleanly. A standard commercial property policy is typically designed to cover business property at a scheduled location: your office, your shop, your warehouse, your facility. That works well for furniture, fixtures, inventory stored at the location, equipment that stays on site, and computers and electronics within certain terms. But many high-value business assets don't behave that way. They move, they travel, they live in vehicles, they go to job sites, they get used in environments that increase risk. That's where the gaps appear. Let me walk you through the 5 most common ways standard property falls short. The first is off-premises limitations. Many policies include some coverage for property away from the premises, but it can be limited, restricted, or subject to a much smaller sub-limit. A business might carry $200,000 of property coverage at their location, but only a small sub-limit applies when that equipment is off-site. A contractor with $40,000 of tools in trucks or trailers discovers this the hard way when theft happens and the payout is far lower than expected. The second is property in transit. If equipment is being transported and gets damaged along the way, coverage depends entirely on whether transit is addressed in the policy. Businesses that move equipment between locations or job sites need to confirm the policy actually follows the equipment. The third is theft circumstances and security requirements. Many theft claims are covered, but conditions matter. Was there forced entry? Was the trailer locked? Was the vehicle secured? Were keys controlled? Were there protective safeguards required by the policy? If safeguard requirements weren't met, claims can become complicated fast. The fourth is valuation and depreciation. If equipment is valued at actual cash value, depreciation can dramatically reduce the payout, especially for older machinery that is still essential to daily operations. Replacement cost coverage is often the better approach for equipment, but it has to be written correctly and supported with accurate values. The fifth is specialized equipment that needs to be scheduled separately. Some high-value items are best protected when they're specifically listed or covered under a form designed for equipment that moves. Businesses run into trouble when they assume everything is included and never take the time to list or schedule what really matters. Here's the question that cuts through everything. What happens if this equipment is gone tomorrow? Would that loss create downtime? How quickly could you replace it? How much cash would it take? Could you still fulfill your contracts? Would you lose customers? When high-value equipment is essential to operations, the goal isn't just coverage, it's continuity. Here's a simple framework to think through your protection. Start by identifying your mission-critical equipment. Make a list of your 10 most expensive items and your 10 items that would stop operations if they went missing. Sometimes those lists overlap, sometimes they don't. Then document each key item properly. Description, model and serial number, approximate purchase date, estimated replacement cost today, and where it typically lives. This supports both underwriting and claims. Then confirm where your coverage actually applies: on premises, off premises, job sites, in transit, and under what theft conditions. Confirm valuation and make sure your limits reflect reality. And when the situation calls for it, add the right coverage form for mobile equipment. The goal isn't complexity. The goal is removing the gray areas before they become problems. This comes up constantly for contractors and trades, mobile service businesses, property maintenance and landscaping companies, event and production companies, medical practices with portable equipment, and tech companies with high-value hardware. If your business depends on equipment that moves, it's worth verifying your structure. Standard property coverage is a great foundation, but for mobile, expensive, or mission-critical equipment, you need to confirm the policy follows reality. If you'd like us to review your equipment exposure and confirm whether standard property is enough, or whether you need a cleaner solution that removes the gaps, visit us at jmwinsuranceSolutions.com/business-insurance.